A synchronized series of structural changes within U.S. equity markets is currently draining capital from the retirement accounts of ordinary Americans. Three massive, heavily anticipated IPOs are positioned to interact with the momentum of passive index funds in a way that forces retail investors into buying overvalued shares. To understand the scale of this interaction, look at the underlying math of the upcoming SpaceX public offering. When the independent research firm Morningstar ran a rigorous discounted cash flow analysis across SpaceX's launch, Starlink, and AI segments, they calculated a fair value estimate of $780 billion. SpaceX, however, is targeting a $1.75 trillion valuation for its initial public offering. This leaves a gap of $970 billion between the independent fair market estimate and the actual asking price. That trillion-dollar premium is completely detached from traditional market sentiment, projected revenue growth, or retail optimism. This $970 billion delta creates an imbalance that regular market mechanics struggle to reconcile. It is a gap that suggests a different logic is at play, one that relies on the specific architecture of the indices rather than public demand. Elon Musk and SpaceX are the immediate prime beneficiaries of this upcoming wealth transfer. They are executing this strategy on the NASDAQ exchange, which recently updated its listing requirements in ways that facilitate a new type of structural arbitrage. SpaceX is the immediate case study, but OpenAI and Anthropic are quietly preparing to follow the exact same playbook in the coming months. The ultimate vulnerability driving this entire mechanism is buried deep inside the structure of everyday passive index funds. The SpaceX offering reveals a scenario where traditional price discovery appears to have broken down, as if the standard laws of supply and demand are no longer the primary drivers of the valuation. The Investment Company Institute's official data currently tracks exactly how much capital sits in visible, registered investment companies like index mutual funds and ETFs. This chart shows the official narrative. Visible passive index funds command 52.7% of all long-term fund assets, officially overtaking active management. But a 2024 academic study by Chinko and Salmon proved the existence of a massive invisible layer of passive capital. This includes institutional direct indexing, active managers secretly mirroring index weights, and vast derivative positions. When you combine the visible and invisible layers, the true passive ownership share of the entire U.S. stock market is 33.5%. That is functionally double the officially reported estimates. The defining behavioral trait of this massive multi-trillion-dollar capital pool is that it is strictly non-discretionary. Economists call this zero demand elasticity. When a company is added to an index, these funds are contractually obligated to buy the stock. They do not analyze revenue, they do not check profit margins, and they never negotiate price. This structural reality creates a market environment where a stock's price is totally decoupled from its underlying value. The demand curve is a perfectly vertical line. The sellers can name any price, and the index funds must pay it. In February 2026, the NASDAQ published a consultation document that quietly rewired this ecosystem. Historically, a company had to trade publicly for 3 months to establish a track record, and it had to offer at least 10% of its total shares to the public. These rules existed specifically to protect retail investors from extreme volatility. The new NASDAQ rules completely eliminated both of these foundational safeguards. In their place, the exchange introduced a 15-day fast entry loophole. A qualifying company now enters the index and instantly forces algorithmic buying after just 3 weeks of trading. They also introduced a 3x low float weighting multiplier, which is far more dangerous. Under this rule, if a company only releases a tiny 3% fraction of its shares to the public, the index applies a multiplier. The automated systems are instructed to weight the company and buy its stock as if 9% of the shares were actually available. The exchange explicitly removed fundamental market protections, allowing the non-discretionary buying power of passive index funds to be used as a source of mandated demand. Applying these new rules to the SpaceX S1 filing reveals exactly how the supply and demand squeeze functions in reality. SpaceX plans to restrict its public offering to a microscopic 3% float, while Elon Musk retains 85% voting control through dual-class shares. Against a $1.75 trillion target valuation, A 3% float means there will only be exactly $52.5 billion worth of actual stock available for purchase. This diagram visualizes the demand side, the entire $1.2 trillion passive NASDAQ 100 ecosystem. Every index fund, every QQQ share, and every derivative product is sitting directly above that narrow $52.5 billion opening. The new 3x multiplier artificially widens the algorithmic demand. It forces 3 times the required capital to violently squeeze through that tiny 3% float. This forced buying completely ignores the company's fundamentals, including a $4.9 billion net loss across 2025 and an AI unit that lost $2.5 billion alone. The resulting ratio is absurd. At this valuation, SpaceX will trade at 67 times sales. That is 3 times higher than NVIDIA's rating. The index algorithms are mathematically blind to unprofitability. They force trillions of dollars to chase a deliberately engineered scarcity. This timeline tracks the chronological trap waiting for passive investors. At day 0, the company goes public. On day 15, the fast entry rule triggers. This is the moment of maximum price inelasticity, where trillions in passive capital are forced to buy the microscopic float, driving the price upward. Then, between day 90 and day 180, the legal lockup periods for corporate insiders expire. Insiders prearrange this specific sequence to guarantee that index buying artificially inflates the stock price well before they are legally permitted to sell their shares. Once the lockups end, early investors, billionaire founders, and venture capital funds begin dumping their pre-IPO shares directly onto the forced passive buyers at a massive premium. In institutional finance, this process is called exit liquidity. It is the systematic use of retail 401k contributions to cash out stakeholders at peak valuations. The current mechanics of index inclusion act as a functional trap, using the mathematical certainty of passive buying to extract capital from long-term retirement savers before they have the chance to react. This wealth extraction is fully documented in academic literature. A March 2025 study from the Wharton School specifically analyzed the impact of passive retirement flows on equity prices. The researchers calculated an extreme price flow multiplier of 12 to 14. This means every dollar forced into these highly constrained indices generates a disproportionate shock to the underlying stock prices. This multiplier leads to massive 30% aggregate price distortions that are based entirely on algorithmic capital shifts, completely disconnected from corporate earnings or reality. Michael Burry, the investor who famously diagnosed the housing collapse, has explicitly warned about this dynamic. The current environment mirrors the unchecked regulatory arbitrage of 2008. In 2008, financial engineers stuffed subprime loans into complex, highly rated mortgage-backed securities. Today's toxic assets are overvalued, ultra-low float IPOs stuffed into the default retirement indices. There is a terrifying difference this time. In 2008, informed investors could choose to avoid mortgage-backed securities. Today, millions of ordinary 401k contributors are automatically defaulted into cap-weighted indices. They have absolutely no choice but to participate in the risk. To defend against this, investors nearing retirement must bypass the default options. 3 actionable alternatives provide immediate distance from the trap: equal weight indices that do not over-allocate to mega-cap entrants, broad international funds, and actively managed value funds that aren't legally forced to buy overvalued IPOs. The exchange rulebook has been quietly rewritten to siphon wealth upward, but informed investors who recognize the mechanics of exit liquidity can protect their capital by breaking their reliance on cap-weighted defaults.